Welcome back and a healthy and happy new year to all. So glad that we are welcoming in a new year. And I got to tell you, I don't care if you're rich or poor, black or white, Democrat, Republican, whatever religion you are, we all agree that getting rid of 2020 is a great thing. I'm sure many of you had some bad days, some bad weeks, some bad months, maybe some bad situations that happened. Personally speaking, I had a family member that was in the ICU for 7 days. So I'm sure that each and every one of you have your own stories. So I'm going to ceremoniously put an end to 2020. Okay, now let's move forward. Coffee with Krav. Coffee with Krav was born during COVID and has been providing topical information, education. We find interesting stories and we try to give helpful life tips. We're looking to continue this tradition and we're going to do it on a monthly basis, the first Tuesday of the month at 10 o'clock. It's the start of the year, so I thought it would be timely to have a global market strategist come on and give us some predictions for this year. So let's get started. Jack Manley. Jack is a global market strategist on JP Morgan's Asset Management Global Market Insight Strategy team. Jack is responsible for delivering timely market and economic commentary to clients across the country and has appeared on both Bloomberg TV and CNBC. He is a contributor to JP Morgan's long-term capital market assumptions and has authored several papers on economy and capital markets. Jack joined the firm in 2013 as an analyst on asset management strategy and business development. He holds an AB in history from University of Chicago. University of Chicago. Very, very impressive. How was your experience at University of Chicago?
Well, Mark, they say it's a school where fun goes to die, but I joined a fraternity my freshman year and ended up being president by my senior year. So I was able to find some fun amidst all the studying. So I got to say it was a good time.
Okay, that's excellent. I'm going to give you my quick University of Chicago story, and then we'll get to the questions. I took my son, this is many years ago, I took my son, he was looking at different colleges and he wanted to look at University of Chicago. At the time, there was no Waze, there was no cell phones. I got a MapQuest paper, I got a MapQuest, and it took me in the wrong direction. And we wound up on Martin Luther King Boulevard on the south side of Chicago, which, as we know from the song, is the baddest part of town. And it was not good for my son and I. And we saw the scariest person. Believe it or not, it was a pregnant woman. And this thin pregnant woman, she scared the hell out of us. It was, but we did finally find University of Chicago. Needless to say, he didn't go there, but that was my University of Chicago.
Well, that'll leave a sour taste in your mouth. It's not the best neighborhood to get lost in if you make a wrong turn.
No, it wasn't, as we found out. Okay, so let's look backward before we look forward. 2020 was a very volatile, unique year. What do you think was some of the best lessons learned from last year?
Well, I think what we learned last year, it was sort of a reinforcing of something that we've been learning over the last couple of years, is that markets move a lot faster now than I think we're used to. I think we're still getting used to the fact that markets move very, very quickly, that you can have very sharp sell-offs followed by very fast rebounds. It was something we experienced in 2018. It was something we experienced in 2019. Usually those things were related to trade policy or to changes in interest rate policy. This year it was related to COVID and shutdowns. But I think it took a lot of people by surprise, not just how quickly markets sold off in response to COVID, but really how quickly that recovery started and how strong that recovery was. And the fact that we ended 2020 up 18% on the S&P 500 after everything that happened. And I think the lesson there, and this is an important one, and it's one that we always try to drive into our clients when we have conversations like this, is that you don't want to try to time the market with stuff like this, because I personally know so many friends who would come to me and say, the market has sold off so much. We're in the middle of this pandemic. The economy is in shambles. There has to be another correction. There has to be another drop coming soon. And that's the lesson, I think, is that it doesn't necessarily have to happen like that. Markets respond very quickly. You have high frequency trading, algorithmic trading, a lot of retail trading on phone apps, all of those things just increasing the velocity of markets. And an important lesson, I think, that things bounce back, and they bounce back. They can bounce back at least very quickly.
Okay, excellent lesson. I truly believe in that as well. And just looking at the biggest winners last year, tech dominated, and the
Mhm.
stay-at-home companies also did. Do you think these companies have legs? Do you think that they can go much higher this year?
So the stay at home story, I think, is sort of predicated on the vaccine story, and where we see things right now. Yes, phenomenal vaccine news. The vaccination program is already rolling out. Millions of Americans have already been vaccinated, but there are hundreds of millions of Americans that haven't been vaccinated yet. And if you look at these sort of loose timelines of when people will be vaccinated, if you are under the age of 65, not a frontline worker, and in reasonably good health, you are not going to get vaccinated until probably sometime in the summer, which means that for a lot of us, this pandemic, unfortunately, is probably going to go on a little bit longer than we'd like it to. It's not to say that things aren't going to get better, because as we vaccinate the more vulnerable people in the community to COVID, the death rate is going to come down significantly. Things will be able to reopen gradually, but we probably still have another 6 months or so of disruption. And so for the next 6 months, as long as we're staying home, as long as we're eating in more than we're eating out, as long as we're spending more time on our couch and less time traveling or walking around or driving or whatever, I think those stay-at-home companies have some momentum behind them. But that is, I believe, temporary, because at some point things are going to reopen. There is a lot of pent up demand to go on vacation, to get on an airplane, to go out to eat at a restaurant. And I think that when you see that, demand for these things that have helped out the stay at home companies is going to not evaporate, but it's going to go back to where it was before. Technology is a little bit different, though. Tech, we believe, fundamentally is a very long term secular trend. And when I say that, I mean that tech is something that has legs not just this year, but over the next 10, 15, 20 years and beyond. I mean, I think the very simple question that you can ask anybody is, do you think technology is going to be more or less important 10 years from now? And no one's going to say tech's going to be less important than it is right now. It is only growing. Most people, or a good portion of people, depending on where you are, will have a smartwatch on their wrist. I see you have one. Is that right, Mark?
I do.
You do. So that's something that wouldn't have made any sense 5 years ago. And here we are today. Good number of people have smartwatches. These glasses that we're wearing within 5 years are probably going to have computer chips inside of them. Tech is just becoming a bigger and bigger part of our lives. What's happened recently, I think, has accelerated some adoption there, but I don't think it precludes future long term growth. The other thing that I think is exciting about tech, specifically as it relates to COVID, is that working from home has been proven to be extremely effective. I think for specific industries, certainly, but extremely effective in a way that I think a lot of businesses weren't willing to admit before they were forced to send employees home to work remotely. I have been doing countless meetings like this. I did my tally yesterday. I think I spoke to maybe 10,000 clients in 2020. I did probably 500 to 600 meetings like this in 2020, the vast majority of those being virtual. They were all high quality, engaging, and they worked well. And I think that the fact that we can work remotely, which is sometimes nice for us, we get to work from home, we're comfortable, we don't have to wake up early, we don't have to put on a suit. It's also good for the companies, because all of a sudden these businesses don't necessarily have to pay for all the real estate to house employees when they can just work at home. And so this work from home transition, I think, is more or less permanent, maybe not to the degree that it is right now, but I think some of it is going to stay here forever. And I think that as long as that's the case, a lot of these enterprise softwares, video chats, things like that, I think are they're supported by some of the changes that we've seen recently.
So going with the technology, and I agree with you, long-term technologies, you have to have tech in the portfolio. But
Mhm.
just take a look at the valuations as they pertain today. It smells, there's some similarities that I see, at least in 2000 when we saw valuations grow. Of course, it's different. Interest rates are different now than they were much higher back in 2000 than they are today. But still, the multiples are relatively high, and
Mhm.
also some of these companies make up a large percentage of the S&P 500 as well as the Nasdaq. So, what's your thoughts on specifically tech valuations at this
Uh,
point?
Sure. So to the index concentration point, that I think is a potential issue, Mark, because to your point, you are buying in. If you buy the S&P 500, you really own 10 stocks plus a few others out there. The other 490. It's not exactly that number, but more or less, you get the idea. There is massive index concentration. And any sort of concentration bears a risk in a portfolio. And it's one of the reasons why being a little bit more nimble, being a little bit more active in the equity space, I think can be worth your while because there is all that concentration risk. But to the valuation point, that doesn't scare me as much. And there are a couple of things to say there. The first one, and this is not directly related to valuations, but it is tangentially related, is that the index concentration when it comes to technology is very similar to what we saw back in 2000. But the difference between now and what we saw in 2000 is that the technology sector and the tech adjacent names, so things like e-commerce within consumer discretionary, or interactive digital media within communication services, the tech adjacent names are pulling their own weight when it comes to earnings contributions in the S&P 500. So if they account for 20% of market capitalization, they also account for 20% of earnings contributions, which is not something you could have said back in 2000. There was an enormous disconnect between what people were willing to pay for these stocks and what they were actually contributing to the bottom line of the S&P 500. The second thing to say about valuations, and I think that this is something you could say about valuations more broadly, but it certainly pertains to the tech sector, is that in an era of lower for longer interest rates, higher than normal valuations are inherently supported.
Right.
And you look at what's going on with Fed policy. You look at how easy it is probably going to be over the next several years. You got to put your money somewhere. Risk assets are generally where your money gets allocated. And then the final point that I'd make on tech, and I'm a big tech bull, Mark. I mean, I'll put my cards on the table. I'm a big tech bull. I don't think we necessarily appreciate the full earnings potential of some of these companies. Now, certainly there are some companies in the S&P 500 that are objectively too expensive that need to be corrected, and I can't speak to those. I don't know them off the top of my head. It's not really what I do, but there are without a doubt some questions, some stocks out there that are too expensive. But you look at how some of these big household tech names have evolved just over the last 10 years in terms of the services they offer, in terms of the customers and clients that they serve. They are very rapid in their development. They're very agile. They're very nimble. They're very innovative. And I don't like to think of future earnings potential for the tech sector in particular using a historical lens. I'd rather look at these companies, see their history of innovation, and frankly assume, and I know it's an assumption, but assume that they will continue to innovate over the next 10, 15 years or so. And so if earnings numbers can catch up and reflect that, then all of a sudden the multiples don't matter so much. So I get why there is some concern about it, and I think it's worth paying attention to. But there are other factors out there that lead me to not be particularly spooked by valuations.
Okay, thanks. The government has and continues to supply fiscal stimulus into the economy in response to COVID. What do you think the implications are with all this money that's been pumped into the system? And what do you think is the long-term implications as well?
Sure, sure. So I think that I think that the amount of money that we spend when it comes to the fiscal response, and that could be the CARES Act or the $900 billion package that was passed right before the new year, or any potential future legislation that we get, depending on what happens over the next couple of days in Georgia, and certainly we can talk about that later if you'd like. that is going to be directly related, I think, to the speed and the strength of the economic recovery between now and the vaccine. So all else not considered, more money means a faster recovery, because more money in people's wallets, more money in people's bank accounts means that they're willing to go out and they're willing to spend it. And this economy is driven by consumption. 70% of GDP is consumption. If people aren't consuming, the economy is not growing, and people can't consume if they don't have money. So the more you spend, the faster the recovery is. Now, ultimately, when you get the vaccine, it's not going to matter so much, because then people get back to work, the world reopens, and spending comes back organically. But let's say for the next 2 quarters or so, the pace of economic growth is going to be directly linked to the stimulus story. So that, I think, is the near-term implication. The long-term implication is that we have a lot of debt. And that is something that has come up a lot throughout the course of this year, after the CARES Act, before the $900 billion package. That's only going to further exacerbate this story. The US government has taken on an enormous amount of debt. And with all of this money that we just earmarked, and perhaps some additional money moving forward, we have eclipsed that 100% debt to GDP ratio for the first time since World War II. And that, I think, is making a lot of people think twice about what's going on here. But when I think about the long-term implications of all of this debt, there are a few things that come to mind. The first is that you should never think of any government, let alone the US government, as being a household. Assets and liabilities do not work the same way for a government as they do for an individual or a household. It would not be sustainable for either one of us or anyone on this line to have 120% debt to income ratio. It is perfectly sustainable for a government, especially one that has a captive central bank and a treasury that prints the world's currency. It's a different story. So to think of it in household terms, I think, is a little bit misleading. I don't think that the U.S. is really at risk of a default, because again, we do have a treasury that prints the world's reserve currency, and we have a Federal Reserve that is willing to buy up a whole lot of issued debt across its balance sheet. I also think it's important to remember that the United States is a very wealthy country, not just in terms of GDP, but in terms of resources, in terms of land, in terms of intellectual capital. The U.S. is not Greece, which was one of the most high-profile kind of defaults that we saw, at least from a developed country, in the last decade. You cannot draw those comparisons. So it's not to say that there aren't bad things that are going to happen because of this. It's just that I don't think there's a currency crisis. I don't think there's a default. The big long-term implication for me is that right now, around 10% of all federal government expenditures are dedicated to servicing government debt, just federal government debt. Forget about state government debt. Federal government debt, 10% of all federal dollars spent, so 10 cents out of every dollar, go to servicing that debt. And that's with interest rates at 0%. Now, let's assume that debt load grows and that interest rate number eventually starts to back up. I mean, not to 5, 6, 7%, but to 2%, 3%. That's a big move when you are considering trillions and trillions and trillions of dollars. And at some point, that number just becomes unsustainable, becomes kind of silly, because it is money that, especially when you're cutting checks to foreign nationals who own a lot of US debt, is entirely escaping the system. It's entirely escaping the US economy. It's unproductive. So you got to do something about it. And what do you do about it? Well, there are 2 levers that you can pull. I don't know who's going to pull them. I don't know when they're going to get pulled, because they're not particularly popular levers to pull. But one of them is raising taxes, and the other one is cutting spending. So where are you going to raise taxes? Well, you're going to raise taxes on the wealthiest individuals, because they're the ones that can afford it, and they're the ones that will make the biggest dent. And where are you going to cut spending? Well, you're going to cut spending on the 2 fastest growing components of federal government expenditures, which, unless interest rates rise very rapidly, are Social Security and Medicare, their entitlement benefits. So we are looking at some point in the not so distant future at a higher tax burden and a reformed entitlement scheme. And when you consider the retirement planning for so many Americans right now, it's very challenged. A lot of people don't have enough money saved up. They don't give themselves enough credit for just how long they're going to live and how expensive life is for the decades after retirement. This problem is only going to get exacerbated. So for me, Mark, it's kind of a call to action almost, to save more of what you earn, invest more of what you save, take more risk in those investments, work with a financial professional to get those goals in order and work towards them. That I think is the biggest takeaway of all this. And it's something scary. It's something we need to pay attention to, but it's not the doomsday scenarios that I think a lot of other people like to point to.
And with all this money that's being pumped into the system, what's your opinion on inflation? Is this inflationary?
Likely inflationary, but to what degree, I think is the big question mark. What is remarkable is that the United States, in the last 30 years, almost really since the early to mid 1990s, we have not experienced core CPI, so that inflation measure that excludes energy and food prices, which are going to be inherently more volatile. We have not seen core CPI move above 3% or below 1% in almost 30 years. That's remarkable. Inflation has been under control since Paul Volcker whipped it into shape through the economy into a recession many decades ago, fixed the inflation problem. So you have inflation that's been very stable. And there are a number of factors that contribute to that. One of them, especially recently, is that oil prices are not particularly volatile. Now, I know that's not included in core CPI, but it is an important part of expenditures. With the United States coming online over the last 5 years or so as the swing producer in global energy markets, it is very unlikely you are ever going to see oil prices up to $150 a barrel again. Much more likely to see oil prices down in the 20s than you are in the 150s, I think. But the two bigger factors, I think, are the very large and growing trade deficit that we have, not just with China, with a bunch of other countries, which means we just buy our goods cheaply from somewhere else. And the other thing is the rise of e-commerce, of online shopping. As consumers, the price discovery ability that we have is unparalleled in human history. Never before in history have the buyers known as much as the sellers, or perhaps even more. And online shopping allows us to shop around, get competitive pricing, very hard to raise prices on that. So you have some really serious anchors on inflation that kept it from bubbling up even after you got the tax cuts back in 2017, another enormous amount of stimulus that we pumped into the economy. Why is this time a little bit different? Why may there be a little bit of inflation? Well, so much of the money that we have spent this year, or last year, I should say, and this year now with that $900 billion package, is disproportionately being directed to lower income, lower wealth individuals. And that's because they're the ones that are being disproportionately affected by the virus from an economic perspective. The jobs that have been lost are the low income, low wage jobs, travel, leisure, hospitality, retail, things like that. And these lower income, lower wealth individuals, they have a higher propensity to spend those marginal dollars. So if you give somebody who makes $25,000 a year a $1,200 stimulus check, you can bet that that $1,200 is going to go straight back into the economy. You give somebody that makes $250,000 a year a $1,200 stimulus check, it's probably going in the savings account or it's probably getting invested. And so all of a sudden you have a lot of this money that's been pumped into the economy that may actually flow through into goods and services. And so now you have these two kind of competing forces. I could very easily see inflation breach the Fed's 2% target. And I think the Fed has acknowledged that through its average inflation targeting framework, which it laid out in a policy meeting, I think back in September or October, that is a possibility. But I don't see 15% inflation. I don't see runaway inflation numbers. I see inflation running hot as being between 2 and 3%, which is something we really haven't seen in the last 5 years or so. So it would feel hot relative to where we've been, but nothing like what we saw in the 1980s or late 1970s.
Let me take it in a different direction here, and talk a little bit about commodities. Commodities have been in a 10-year bear market. Goldman Sachs Commodity Index over the last 10 years has gone from 36 to 9. That's a negative 13% rate of return per year, nearly the opposite of what equities did during that same period of time. Do you think that we're going to get a regression to the mean? Do you think that commodities now, maybe the next decade or next 5 years, or do you think that this will be a continuation of the same trend?
Well, when you look at commodities, I mean, very high level, I kind of break commodities down into oil, gold, everything else, because those are the two that people really like to talk about, oil and gold. And if you think just to 2020, oil and gold moved in opposite directions. I mean, there was a period in April or May I'm sure everyone remembers where oil futures were trading at negative prices,
Yeah,
where oil
I did.
producers were paying people to hold
Yeah.
on to their oil because there was just this glut of supply. Gold had an incredible year last year,
Mm.
and that's because people were worried about inflation. They were worried about a lot of doomsday scenarios where COVID, causes the fall of the United States and the Treasury stops printing money and the whole world falls apart. And gold has this intrinsic value because it's shiny and pretty, and so we can buy a lot of it, and that'll protect us. So they did move in different directions. So not all commodities, I guess, are created equal. But when I think about the long term trajectory of commodities, the thing I like about commodities in a portfolio is that they are, traditionally speaking, inflation hedges. And it's because they're priced in dollars, which allows them to kind of move along with the dollar, which will move along with inflation. All basically every oil contract that is completed around the world is completed in U.S. dollars. When you quote gold prices, you quote gold prices in USD. You don't quote them in euro or in yen. You quote them in USD. Commodities are priced in dollars, and so they are a little bit more inflationary. They're a little bit more resilient towards inflation. And so we are kind of thinking about commodities having more of a role in a portfolio moving forward. Not a huge role, no more than 5% or so, but for those investors that are concerned about inflation bubbling up in the aftermath of all this spending, gold does make a little bit of sense. Is gold going to have the same extraordinary year that it did in 2020 now in 2021? Probably not, since we're in the middle of this recovery. There may even be some downward pressure on gold over the next year or so because things are getting better. But gold, I think, it has sort of that long-term inflationary hedge potential. Oil's a little bit trickier. I think that oil prices are going to get higher. They're going to rise over the next 12 months or so. But I do think that COVID has fundamentally changed the energy game, perhaps forever. And the reason I say that is because no one's getting on airplanes and very few people are commuting to work or really driving around anywhere. So there is structurally less demand for energy right now than there was a year ago. The trade war was extremely disruptive for global trade volumes. People weren't shipping stuff as much because we were in the middle of a trade war. If you're not shipping stuff as much, you don't got to fuel up those tankers. Less demand for oil. And you think about trade policy moving forward, I don't think the trade war is going anywhere. So this is something we're going to have to be grappling with. You think about working from home as being a longer term sort of solution to this problem, probably less demand for traveling. You think about a potential hangover effect associated with COVID, where even after you've been vaccinated, still feel a little bit uneasy taking a middle seat next to a stranger on an airplane. I think all of these things point to a 5 to 10 year window where oil prices maybe rebound a bit to account for a reacceleration in global growth, but don't necessarily get back to where they were, let's say 5, 10 years, or even a year ago. And by the time they do recover, who knows what's going to be going on with green energy, with solar, with electric, water, whatever it is. I think that oil is a little bit of a trickier play. So when I think about commodities, I lean more into that gold story as that inflation hedge.
Okay, Jack, just for a second, I just want to talk to the audience. If you have a question for Jack, you can email me, and my email address is mkravitz, KRAVIETZ, at aline, wealth.com. Again, mkravitz at alignwealth.com. So if you have a question, please email me. Now, Jack, I did get a question or two during the week, so I'm going to read one of the questions
Sure.
that I got. Any comments on digital coins like Bitcoin? And then, secondly, is that if you're going to hedge, would you rather hedge with Bitcoin or gold? And is that even a hedge against the markets?
So I will tell you, I am not a classically trained economist. You read my bio. I'm a history major. But my boss is a classically trained PhD economist, and I've worked with him for many, many years, which means that a little bit of this has rubbed off on me. Any economist worth his salt is going to tell you that cryptocurrency is nonsense, whether it's Bitcoin or Litecoin or whatever. They are clearly not good stores of value, right? I mean, Bitcoin prices went from $20,000 a coin to $35,000 a coin in 3 weeks and then dropped from $35,000 a coin to $28,000 a coin in 4 days. That is not a store of value. It is completely unpredictable. You also can't really use it to do anything. You can't go to Walmart and buy whatever it is that you're buying with your Bitcoin collection or whatever it is that you want to call it. Certainly there are some businesses that take it, but it does not take the place of a dollar. It doesn't even take the place of gold. You could probably go into a mom and pop store and take off your gold watch and trade it for a loaf of bread, right? I mean, it wouldn't be a good trade for you, but you could probably do it because people know that gold has some sort of intrinsic value that exists there. So we don't like cryptocurrency. Now, I'll share a funny anecdote with you, Mark. My best friend from college is a physicist, and he got his master's in physics also at the University of Chicago. So he's a very bright individual and is a huge cryptocurrency bull, and put maybe $1,000 into Bitcoin back in 2012 and turned it into $750,000 in a few years. So I look like the jerk when I'm saying this makes no sense. This makes no sense. And meanwhile, he's rolling in the dough. But I do think it is important to remember just how volatile this is, and just how useless, for lack of a better word, these cryptocurrencies are. If you're going to hedge, I'd rather hedge with gold, which is more predictable in terms of prices, is also more easily exchangeable, and actually has applications even outside of the currency. You can make jewelry with it, you can make tools with it, you can make all sorts of things. That said, the technology that underlies Bitcoin and other cryptocurrencies, so the blockchain, is very much the future. I mean, you already have massive Fortune 500 companies, JP Morgan including, adopting blockchain technology in some capacity within their businesses, because blockchain allows for a very, very rapid settlement of contracts, which means that things like derivatives, swaps, options, whatever, are settled instantly, as opposed to being settled in, say, the next 2 days. There's some very serious money-saving implications, time-saving implications behind the blockchain. So if you are excited about crypto and Bitcoin and whatever it is, but you don't want to take that roller coaster ride of investing in an asset that is going to fluctuate wildly over the course of many years, I would invest in companies or industries that are relying more and more on the blockchain to improve their efficiencies, because that, I think, could be an edge in future business development for these companies in terms of the products they're able to offer, the speed they're able to offer them at. And so that is where I would kind of get my allocation to that sort of thing.
Okay, thanks for that. So let's shift overseas. Brexit is finally done. I know it started in 2016, but January 1st, they said it's official of this year. I understand that you graduated with honors at University of Chicago. You mentioned in British history.
That's
So
right.
when we look back at Brexit historically, do you think that it was a good idea?
Well, that's a loaded question, Mark. I mean, I'll tell you
That's all I do is
my
loaded questions. That's
I'll
all
tell
I
you
do.
from my background as I hate calling myself a British historian, but as someone who studied British history in college, the whole reason the UK is the UK, and Great Britain is Great Britain, is because of trade. I mean, it is a tiny island nation with basically no natural resources to speak of, that became, over the course of a couple of centuries, the most powerful empire the world has ever seen. I mean, the sun never sets on the British Empire. That was a thing that was true up until not so long ago, up until maybe 100 years or so ago. And the only reason Great Britain was able to do that was because of trade. Without trade, Great Britain would be a little rock in the middle of the sea over there. And so from a historical perspective, it is a little bit funny that the UK kind of rebuffed this trade deal that exists, because at least from an economic perspective, the UK needs Europe a lot more than Europe needs the UK in terms of the free moving of goods and services. The other issue with the United Kingdom, and full disclosure, my boss is an Irishman, born and raised right outside of Dublin. So he is from the Republic of Ireland, not from Northern Ireland, which is an important distinction to make. There is a very real, very serious question of the Irish border in Ireland. People can very easily forget what IRA terrorism looked like. Again, not so long ago, 30 years or so ago, you had buses getting blown up in London. And it was, it was done by Irishmen, by people in Northern Ireland or people in the Republic of Ireland that were trying to fight for Irish independence. And one of the reasons that these things have calmed down is part of the Good Friday Accord, is that there is a soft to almost non-existent border between the Republic of Ireland and Northern Ireland. So you can go in and out very, very freely. And that is at least a product of the European Union. The fact that the Republic of Ireland is still in the EU, and at the time, Northern Ireland was still in the EU. If you were to all of a sudden put up a hard border on the Irish border with armed guards at checkpoints, it feels a whole lot like the late 1980s, early 1990s. And that was a humanitarian crisis just bubbling. So there were a couple of things where you look at this and you kind of scratch your head and wonder, why would you go ahead and do this? At the same time, I think it is perfectly reasonable for Ireland, or rather for Great Britain, to not necessarily want to take all its orders from Brussels, which is where a lot of these policy decisions were being made. Frankly, you can make you can draw a lot of parallels to the United States. I mean, we're big in terms of states' rights here. Not all states function the same way. A lot of states are resentful of federal government policy, whether it's red or blue. They don't like being told what to do. That is sort of what you saw from an emotional perspective over in the UK. So how are things going to play out? It's hard to say. If the UK does take a hit, I think it is going to be a temporary one. I think what you're going to end up seeing, and we've already started to see as part of these negotiations, is you don't really even notice that it happened, because they have made things so similar to where they were before in terms of free movement of goods and people, in terms of immigration laws, in terms of all of these things that allow people to continue to work in London and serve the continent. I think you're going to see a lot of these things kind of held on to, which means that whatever disruption you see, I think is fairly temporary. So it's hard to see. Like you said, it's been going on for 4 years, seemingly with no end in sight. Finally, it's over. It may take another couple of years to actually figure out what this all means, but some things to think about, I think.
So I think that I would be remiss, especially to everybody that's listening, if I didn't mention the Christmas tree that you have there. That's a very nice looking Christmas tree.
Thank you.
I'm sure you went out like most Americans and you went and chopped that down yourself, right? You did that, right? Am I correct?
Come on, look at me, Mark. I'm clearly a desk jockey. No, it's funny you mentioned this. So this is a beautiful tree, and I appreciate you saying that. Now, what's going on in New York City, where I live right now, is that Christmas trees in New York City are they were, pre-Christmas, extraordinarily expensive. I was shopping around a little bit. They have these stands set up every couple of blocks. A 4-foot tree was going to cost me about $90 plus tax and tip. This is a renewable resource. They literally grow out of the ground. The fact that you would pay that much for a plant that is not that big seemed insane to me. And there are a number of reasons for that. There's, I think, a lot of demand because 2020 was a bad year and people were willing to, stay home and splurge a little bit on something like this to really make their house feel warm and happy and whatever. The other thing that I've heard is that because of COVID, a lot of the farmers from up in Canada, specifically Quebec, who come down to New York to sell Christmas trees, were either barred from entering or didn't want to come down here because of the pandemic. So you had a huge amount of supply, huge amount of demand, not a lot of supply. It was a great year to be a New York-based Christmas tree seller because you could just take people for all they were worth and they would do it with a smile. So to give you an idea, a tree like this, probably about 7 feet, would have cost maybe $300 with tax and tip. And I say would have cost because I had resigned myself to not getting a Christmas tree this year. I live
Shame
alone.
on you.
Honestly,
Shame.
you're not the only one that told me that. You are not the only one that told me that. But I was like, I live alone. I decorated my place otherwise. I had lights up, I had ornaments up. It looked festive, just no tree. And I was running an errand, and I walked past somebody setting out this big, beautiful 7 foot tall Christmas tree on the sidewalk to throw it out. And I looked at it, and it's clean, it's healthy, it was very much still alive, it had a stand with it, and this guy was just tossing it. And I suspect it's because, and I have no proof of this whatsoever, but I suspect it's because this person was going off to their in-laws, or going on a vacation with the family, and they didn't want to come home to a dead tree. So they had it in their home. It's beautiful, it's bright, it's lovely, and then they chucked it right before they left. And so I picked this thing up, and a 7 foot Christmas tree weighs a lot, and it's not particularly easy to carry. So I picked this thing up by myself, lugged it a couple of blocks into my apartment, lugged it up to the fifth floor of this building, and set it up. And so I'm very proud of it. It's one of the reasons it's still up right now, is that I'm proud of it. And I'm hoping that next year, when everything else comes back to normal, Christmas tree prices come back to normal too.
Well, yeah, it was a very good value play for you. You got a
Excellent value play.
free Christmas tree. Speaking of value plays, speaking of investments, we were talking a little bit about international investments. What do you think about investing internationally, and and what do you think about the emerging markets as well?
So international investments, from a value perspective, are very attractive. They were before COVID cheaper than their long-term average. Now they're a little bit more expensive than their long-term average, but the bigger comparison is that they're cheaper relative to the U.S. and have been for quite some time. So there is a valuation argument to be made for international assets. There is also an income argument to be made for international assets. If you look at the S&P 500 dividend yield, it's around 2% or so for the S&P 500. The MSCI All Country World ex-US, so every other stock market out there except for the United States, has a dividend yield of around 3%. So it is 50% higher than what you get here in the US. And when you consider that yield's pretty hard to come by, that's a pretty attractive proposition. The other thing that has that is working for international investing right now is that the dollar is very high, and it is set to depreciate. And as the dollar falls, that is a tailwind for US-based investors, for dollar-based investors in overseas assets. The fourth thing that you have going for international, specifically developed international, is that places like Europe, places like Japan, they are very cyclical in terms of their index composition. So the United States is dominated by technology. Europe does not have a tech sector. Japan doesn't really have a tech sector, not in the way that the United States does. They are much more cyclical, which means they have more exposure to financials. They have more exposure to materials, to industrials, to energy. Now, cyclical names like these have gotten beaten up throughout the course of 2020, throughout the course of COVID. And so when the recovery starts in earnest, there is, at least in theory, very strong outperformance potential from these cyclical regions. So you have a falling dollar, cheap valuations, an income argument, and a cyclical tailwind that should all, in theory, lead to outperformance of international markets, developed markets in particular, next year. Now, there are some caveats there, though. The income story has been true for years. The valuation story has been true for years. And yet, international has not outperformed the US. Some of that clearly has to do with, I think, with technology, but there are bigger issues at play. I mean, Europe has a lot going for it. It also has a lot wrong with it. Europe has, thinking about Europe as a block is a little bit challenging. I like to look back into 2019, the days before COVID. Europe dealt with Brexit, which we know was also in 2020 and in 2018 and in 2017 had Brexit. It had Catalonia voting to secede from Spain. You had widespread year-long labor unrest in France. You had multiple political and fiscal crises in Italy, and you had Germany on the brink of a recession because you were in the midst of a trade war and they didn't want to stimulate their economy with fiscal spending. Those are 5 things that happened in 2019 that are almost cultural in nature. You think of France, France is always on strike. You think of Italy, it is always chaotic. You think about Germany, always stubborn when it comes to spending. Those were not unique problems to 2019. They were problems that could happen at any time, anywhere. And the only reason we didn't hear about them again in 2020 is because COVID came around and it was a bigger story. So Europe has a lot of structural headwinds, I think, a lot of headline risk, we like to call it. So when I think about Europe, I focus in on what they do really well. And to me, what Europe does very well is luxury goods. That is their bread and butter, is nice watches and cars and wine and handbags, that sort of thing. And as the world gets wealthier, particularly as the emerging world gets wealthier, those European luxury goods, they are status symbol items. There is an enormous amount of growth potential there. You look at Japan, again, a lot going for it on paper. The issue with Japan is that their demographics are abysmal. You have a significantly older population in Japan than you have in the US, significantly less immigration than you have in the US, a significantly lower birth rate than you have in the US, and a country that, again, is culturally predisposed to not spend, to save. It's why that helicopter money policy didn't really do anything for Japan, because all those pensioners just took that money and stuffed it under their bed. They didn't put it into markets, they didn't put it into goods or services. So that's a very serious issue with Japan. You know, a lot of people don't realize that the Nikkei today is still below where it was at its peak during the Japanese dot-com bubble. I mean, that is insane. Japanese markets have still not hit record highs in 30 years or more, which is just amazing. Their economy grows very slowly. Their inflation is almost non-existent. Again, structural headwinds there.
What particular countries would you buy here?
So
what's your favorite countries?
So I like Mark. I like the emerging world a whole lot more. Frankly, I think it's an easier story to tell, and I like emerging Asia in particular. Not a big fan of Latin America. I think you have a lot of political and social issues there. Not a big fan of EMEA. Think about Middle East, North Africa, that sort of thing. Again, a lot of political, social issues, and both Latin America and EMEA heavily exposed to commodities, which are inherently volatile. We like EM Asia, so places like China, but also Taiwan, Vietnam, Indonesia, India, Thailand, all these places, Korea. We like these places because they're heavily exposed to manufacturing. They're heavily exposed to the consumer. You know, if you or I go out and buy a new computer, chances are it's made in one of those countries. And they have a very rapidly and large growing middle class. If you look at India, you look at China, those two countries alone are going to contribute around 1 billion people to the global middle class over the next decade. That's an enormous aggregate purchasing power that is coming online over the next 10 years. And that, I think, is an inexorable force. And so for us, where we look overseas, and not everybody shares this view, Mark, this is sort of how I feel about it, but I like to barbell my allocation between the US as a high quality play, EM as a really high growth, high octane play. And there are certain pockets of opportunity in developed markets like luxury goods in Europe, robotics in Japan would be another example. But in terms of broader index allocations, EM Asia and the US.
So let's say next 5 years, you think China will outperform the United States markets?
If it is left to its own devices, China could outperform US markets. There's a lot of stuff going on in China right now in terms of regulation. China is a party-controlled country. It does not operate like the United States does. And while we thought that it was moving more liberal in terms of becoming more Western, it has actually moved in the opposite direction. It's become a little bit more authoritarian. Russia is a similar instance of that. Now, China, I think, has a competitive advantage over Russia. You got more people, better governance, more land, less reliance on commodities, but the issues, I think, are generally speaking the same. Will China outperform the US over the next 5 years? That's a little bit tricky because of the political story there. But there is a lot more to EM Asia than just China.
Right.
When you think about the opportunities in Korea, in Vietnam, in Taiwan, these are very, very high growth areas. So the index the index itself, so EM Asia, if you want to think about that as an index, I do think over the next 5 years will outperform the US. Frankly, a lot of people don't realize this, but EM Asia or emerging markets more broadly outperformed the US over the last 15, 16, 17 years. The issue is that they went like this.
Right.
And so if you got in at the wrong time, it was horrible, right?
Right.
And your returns were abysmal.
Right. I remember the late 90s, EM did absolutely fantastic. I major moves on the upside. So let me just again announce, if you have any questions, we're coming very close to the end. So if you have any questions for Jack, please email me, mkravitz@alinewealth.com. I'll ask you one more question, and then we're going to do a lightning round, unless we have any questions from the field. The housing market,
Mhm.
it's been very, very solid. I read due to lack of building over the last bunch of years, we're only in the fourth inning. What's your thoughts on that?
So I think the housing market right now, I mean, that's an interesting point. For first of all, there hasn't been a ton of supply coming online, which is inherently going to be good for prices. The other thing when it comes to the housing market right now, and this is painting with broad brushstrokes, but I think it's worth acknowledging, is that the people who have suffered this year because of COVID, the people that have lost their jobs because of COVID, are not your typical homeowners. One of the more startling statistics I think that you can put out there is that the average weekly earnings of someone within the retail component of the U.S. economy is around $400, like $400 a week. It's not a lot of money. It is not enough money to own a house unless it's not a really nice house and not a really nice part of it, not a really nice bigger part. So most of these people are renters, which is why the housing market in terms of ownership hasn't really suffered that much. In fact, in some instances, it's benefited because people are leaving their cramped New York City apartments and they're moving out to New Jersey, or they're moving to Long Island, or they're moving up to Westchester, and they're buying bigger houses, more space. They got kids. The kids are getting educated at home. All of a sudden, both spouses working and three kids learning in the same, 1,000 square feet just was not going to cut it anymore. And so you've had some, I think, strong sort of tailwinds behind the housing market recently, on top of all those other kind of structural issues that you were talking about. I do think you are starting to see a lot of migration around the country. So people in New York, for example, a lot of us are moving down to Florida. The weather's nicer and the taxes are lower. You have a similar story out west. Back when I used to travel, I'd go to Las Vegas for work, which was fun. That was nice. If you go to Vegas for work, but you go to Vegas, you go to Phoenix. It felt like half the people there were California transplants because they didn't want to live in California and pay all those taxes. They could get the exact same weather, significantly lower cost of living. And look, unless you are living in Malibu, inland, 100 miles inland in California is going to look like anywhere in Arizona. It is indistinguishable other than your extraordinary tax burden that you're paying. So I do think you see a lot of room for these sort of secondary cities to bubble up in terms of prices. So you think about places like Austin that have become really, really hot recently. Austin, places like Nashville, places like Denver, like Seattle, these kind of, big-ish cities, but they're not LA, they're not New York, they're not Chicago, that could see a little bit of upward price pressure at the expense, though, of, I think, homes in higher tax areas, especially if that sort of prediction that we made earlier, Mark, comes true and our tax burden goes up at some point in the next 5 to 10 years. Maybe you don't want to deal with all the state taxes on top of all those federal taxes. There's a very real possibility that my New York City taxes are going to go up because of COVID. I mean, that's, it's tempting to leave. And so I think that there are pockets of opportunity for the housing market. I would never say the housing market's done. I don't think COVID came anywhere close to killing it. But I wouldn't necessarily say that buying a penthouse in the brand new New York City apartment building that went up in Midtown is like your best investment right now. I'd probably rather buy a home somewhere in the Dallas Fort Worth area, or in the Seattle suburbs, or something like that. So room for growth, but I think pockets, not broad based.
Okay, excellent. Well, we're going to go to the lightning round. You ready for the lightning round, Jack?
All right, let's do it.
Okay, so some of these are either or, some of them you'll get it, but I want a quick answer. Ready?
Okay.
U.S. and this is for this year. U.S. market or international market?
International.
Okay. Emerging market or developed international markets?
Emerging.
Okay. Moderna or Pfizer vaccination?
Pfizer.
Okay. Inflation over or under this year, 2.25%.
Under.
Quick? Under. Okay. All right. Gold or Bitcoin? I think I know the answer to this one.
Gold.
Yes. Okay. US dollar in 2021, up or down?
Down.
Okay. Small cap or large cap?
Small.
Okay. Value or growth?
Value.
Okay. $2 trillion more of federal help this year, yes or no?
No.
Okay. New York Knicks win a championship before 2030, yes or no?
Never.
Never. You're killing me here. All right. Last question. Who will win the Super Bowl?
uh, Bucks
No, Super Bowl. Football.
and
Not,
Buccaneers.
oh, the Buccaneers. I thought you
Yeah,
meant the
sorry.
Milwaukee Bucks.
No, not Milwaukee.
Oh, Tampa Bay Buccaneers. You're going with Brady.
I'm going with Brady.
Interesting.
And I
Yeah.
hate that as a New Yorker. I hate rooting for it, but probably.
You just had everybody turn off.
Yeah, I
Everybody,
know. I'm sorry.
everybody, there's no one left. It's just you and I now.
I'm
Everybody's
sorry.
like, they all hate you now. Oh my God. It's terrible.
But
All right. Well, Jack, you said it all. I thank you so much for the information. It's great information that we can all hopefully utilize this year. So really appreciate it. Thank you everybody for joining us with Coffee with Krav. We're going to be back on Tuesday, February 2nd. So same bat time, same bat channel. We'll see you then. Thanks so much. Have a great month. Take care. Thank you.